afternoon. Today, we are pleased to welcome back Weaver Fintech to Unlock the Stock. This platform was created for retail investors to connect with corporate management and to get to know them and understand their companies a bit better. We are joined by Weaver Fintech CEO, Sean Wibberley, and Paul Burnett, the CFO, who will take us through a presentation shortly. Unlock the Stock is only possible with our technology partner, Lumi Global. You can visit their website at lumiglobal.com to discover more about their various online AGM and investor presentation solutions. The Q&A session today will be hosted by the Finance Ghost and Mark Tobin of Coffee Microcaps. Before we start, there are just a few housekeeping notes. The company will present a presentation which will be followed by a Q&A session. You can post your questions by typing them into the chat box, which is at the bottom of your screen. The event is being recorded and will be available on our YouTube channel soon. You will also see an email address when we begin the Q&A session, and if you would like to be placed onto Weaver Fintech's investor distribution list, please take note of that email address and reach out to them. I am now going to hand you over to Sean and Paul to take you through the presentation. So, Sean, you are welcome to share your screen with us and go ahead with the presentation, please.
Good afternoon, everybody, and thank you for your time as Paul and I will take you through a brief set of slides that echo the slides we presented to the market on Tuesday. This being our 2025 annual results. I'm very, very, very pleased to present these results. We've had a stellar year. You can see the trajectory over the last 5 years of sustained growth. And as a group, 23% up on revenue and then over 40% up on our group profit and our profit before tax. Our headline earnings up to over 550 cents, so up 40% on the year. And we declared a final dividend up 36% of 132 cents. Just a little bit of background, Weaver Fintech, we rebranded to be called Weaver Fintech on the JSE. We were called HomeChoice International. The business is now 93% profit driven by the fintech business, hence the rebrand, as we considered it more appropriate to be branding ourselves aligned with the type of business that we currently are, which is very, very much a fintech business. The fintech business covers lending, payments, insurance, and shopping on an ecosystem. And our retail partner, our retail business, HomeChoice, is the heritage business, has been with the group for 40 years. And they are an at a distance seller of homewares and recently have made a move into showrooms. The customers within the group, we've been focusing on the urban Black African female as our core customer segment since the beginning of this group 41 years ago. She is the fastest growing sector within the mass market middle income part of our economy. You can see on the top right, the growth of credit active females grew by 15% versus generally at 12%. So this segment that we target specifically is a high growth segment. We know it really, really well. We've got 4.3 million customers that grew 40% last year, and we represent about 18% of the credit active market in the country. And you can see the distribution of ages, approximately a third across the different banding. We represent about 64% of our customers being millennials and Gen Z. So we obviously do also serve men, but 70% of our base is female. Looking at some of the global trends and how these precipitate into South Africa, digital wallets and buy now, pay later are mega trends overseas. And globally, wallets are used between 50 and 80% by millennials and Gen Zs in 2025. In SA, that was 35%, but we strongly anticipate wallets growing as a share of use by consumers in South Africa. And then similarly, buy now, pay later. It's become mainstream. 60% of consumers globally used the product last year. In South Africa, 45%. And again, we're going to follow that mega trend. And I believe the growth rate for this particular line of business, BNPL and wallets, is going to really grow next year. We have a small market share in South Africa for digital payments of just under 2%. And we anticipate BNPL as a category to double in consumption next year in the South African economy. Our particular brand is very well downloaded across South Africa. It's the #1 BNPL in SA. That's the PayJustNow BNPL product. And we're the #3 and #10 downloaded financial app in the apps in the Apple App Store and the Google Play Store. Strategically, just looking at the ecosystem, how we constructed broadly, we have 4 million consumers on the fintech side. We have 3,500 merchants on the merchant side, and a range of products and integration between the merchants and the consumers. This flywheel effect is a really virtuous one. The more merchants we have, the more attractive we are to shoppers. The more customers we have, the more attractive we are to merchants as they seek new customers and want to leverage the payment products we offer to drive more demand, conversion, and sales through their tills. About 62% of our merchants are currently in store, the remaining being online. And going forward, we really want to radically increase the number of merchants to add another 10,000 or so and get a significant growth in merchants in 2026. Customers trust our brand. We've been doing this for a long time. We've got deep focus on the customer. We've been selling at a distance for 40 years in the group. And our retail heritage, our understanding of credit, the data that gets generated by this ecosystem really comes to bear in terms of how we can offer and personalize our products to our customers. And our products are all embedded in the ecosystem, so she can interact with them by going to our platforms, signing up for the product, using it, engaging, and then cross-selling into other products. And we own our tech stack fully. Looking at the life cycle of a customer, typically we garner customers into our ecosystem with the buy now, pay later product. It's a very virally adopted product. Consumers love the fact that they can split their payment 3 ways at the till without any fees or interest charged for on-time payment. So, for example, someone buys something for 1,200 Rand at the till, they only pay 400 Rand now, 400 at their next payday, and 400 the following month on their subsequent payday. This brings in a lot of customers, and based on behavior on those customers and the data we get from her transactions, and also obviously coupled with bureau data, we are able to offer a pay stretch product, which is a pay in 12, a longer term product, our Maybe Money product, the FinChoice Maybe Money product, a term loan, and obviously our funeral and accident products. That's the journey typically of cross-sell. We've grown the number of customers who have 2 or more products by 28% in the year. And you can see what happens when we do this on the bottom right. The ARPU, or the average revenue yielded over a 12-month period, jumps significantly when the customer takes that second and third product. So from about 1,200 Rand per year in recognized revenue from a 1-product customer, it jumps to almost 10,000. And if you take 5 products, that customer is generating 18,000. So it's a really strong ARPU drive. And this flywheel of cross-selling within the ecosystem is a core strategic intent of ours. We want to have 50% of our customers having at least 2 products actively in the ecosystem. Broadly, looking at the different verticals within our ecosystem, we take it for granted how inclusive and engaging we are with our customers, because it's part of our DNA. We've been doing this for 40 years, selling and engaging with customers at a distance, which means we've learned how to talk to her, to use data to personalize our offers, and to really generate trust within a distance relationship. And that plays very nicely into digital and into our ecosystem strategy, where she engages with our products on a platform. We've got the range of products to your left: lending, insurance, payments, and lifestyle. These are in play at the moment. Lending we've been doing in the FinChoice brand for 20 years. Insurance we've been doing for more than 10 years. Payments we've been doing for 5 years with the acquisition of the PayJustNow buy now, pay later platform. We are the biggest BNPL platform in South Africa at the moment. And then our shopping and lifestyle destination, where she can come to the platform and discover great deals, new stores, merchants, and other merchant offerings. So those are in play. We'll shortly be launching our own mobile network called PJN Mobile, where we will be offering customers data and airtime to really reward her for her engagement in our ecosystem. And then wealth, this is where we're going to be adding a bank account linked to a debit card to access our credit and payment products in partnership with a sponsor bank. And in time, we will start augmenting that to offer her ways to save and generate wealth in our ecosystem. More specifically on the mobile phone, we're going to launch this in about the middle of the year. We don't see this as a big money spinner in and of itself. This is going to be an engagement play, a stickiness play, a rewards play for our customers. So she'll get access to discounted data and airtime, and also free data and airtime because of positive behavior on our ecosystem, such as, for example, paying her insurance premiums on time, honoring her debt-free payments and not missing a beat and then getting rewarded for that. So a very virtuous offering for us to leverage. And then next year, as I've mentioned, the PayJustNow debit card, both virtual and plastic, will be on offer to our customers in 2027. Paul, I'm going to ask you to speak to some finance slides for everyone. Thank you.
Thank you, Sean. And yeah, hi everybody. It's great to be able to speak to you this afternoon. Thanks for taking the time. Yeah, likewise, I'm very excited about these results. It's been a milestone year for us as a group. So, and I'm going to be focusing in on profitability, how we're driving improved margins, and secondly, how we are actively allocating our capital to improve our returns as well. So I'll speak to those now. So revenue up 23%. We've managed our costs well, only growing at 11%. And that's converting really well to a profit before tax and headline earnings per share up 40% year on year. How have we done that? We have purposely targeted fees revenue, so it's a higher margin product. It generates more cash for us. We have a very low customer cost of acquisition, so that's relative to other players, that's extremely low. We also have high retention rates. So not only does it cost us less to acquire new consumers, but secondly, we keep them on for longer than others. So we've got very good engagement with them. And something that's been consistent over several years now as well is just how digital we are. So we're a digital business. We've targeted this, and we continue to yield benefits from that. So we've got controlled investment in tech and data, but we are also targeting that improved cost management as well. As mentioned when I shared with the market on Tuesday, these are things that we've been quite purposeful over some years now, and so it's very satisfying to see how we have this track record now of converting this high growth into improved profitability and higher returns as well. If we look at the next slide, so on profitability, if we go into a bit more detail on that. Sorry, Sean, are we going?
Are you on slide 11 there, Paul?
Sorry, thank you. So that speaks to the improved profitability. If we look at the capital allocation, so as a group, we've purposely allocated our capital. There are two underlying businesses in the group. and the heritage business, the retail business, the returns and profitability in that business haven't been good enough over the years, and we've restructured that business in the last year. Okay, what does that mean? Is that we're not allocating any further capital to that business going forward. That business has been, its cost base has been cut, and we've reviewed the balance sheet in terms of the returns that we're requiring from that business. So it is now targeting double-digit margins and returns going forward. So we've been quite purposeful on the retail side. And what we've continued to do, so quite consistently over the year, is to allocate capital to the fintech business. And you can see in our summarized cash flow on the left-hand side. So we've invested another 1.4 billion rand into the profitable fintech receivables book. We've continued to invest in data and tech. And so from a capital expenditure point of view, in a controlled way, we're investing in the scalable tech on the fintech side. And this does require funding. So we've also continued to grow our funding relationships. We've got very good support from our lenders. During the year, we upsized our funding by a further 1.25 billion rand. We've ended the year with very healthy headroom. So we've got 1.5 billion rand of cash and facilities available to us. So that's key for us to continue the growth trajectory going forward. And in the medium term as well, we are also talking to our lenders about a future notes program. So what is this doing then from a group returns point of view? So we're very pleased with a 370 basis points lift in our group return on equity. So that's now at 14.7%. To give you a sense of looking forward though, so if we I'd like to share some more color in terms of the fintech returns. So Sean, if we can move on a slide, please. Oh. No, sorry, we'll return to that later. Apologies. If we can keep moving, Sean. Thanks.
We're going to go through Paul.
Thank you. And then on the retail business, I'd like to slow down here. So this business is the heritage business in the group, but we've gone through quite a comprehensive restructuring in it. The returns of this business haven't matched our benchmarking expectations, and they're well below those of the fintech business. Okay, and so what this business has been, we've restructured this business. We'd like it to be a niche retail player with a double-digit returns and margin going forward. That's a key strategy for us. How have we done that? So we've right-sized the product range being sold. We've tightened the credit criteria so that we are improving the quality of the retail book. And we've also shortened the term. So that's quite important for us in terms of driving a higher balance sheet return. And we've shifted out of the tele channel to be driving the majority of our new customer acquisition from the showrooms channel. So those are quite significant shifts. What this has resulted in is a one-off non-cash flow impairment. So it's an accounting adjustment, so that's required in terms of International Accounting Standard 36, and that's a 244 million rand impairment against the retail business. And this is the right adjustment to be making for this retail business going forward, so that it's then achieving improved returns going forward as well. So we are quite pleased with the changes that have been implemented in 2025 and the right base that this business is growing off going forward. Sean, if we then go on to the next slide. And so focusing in on the showroom strategy in particular. So we've grown the showrooms during the year. So there were an additional 22 showrooms that were opened during the year. So that's now at 60 showrooms. We will be slowing down that growth So we expect to add between 1 and 5 in 2026. So it'll be slower growth than was much slower growth than this year, and the focus will be on improved profitability and returns coming off this business going forward. What you can see is the good shift in sales mix coming from showrooms. So showroom sales of 25%, showroom sales mix growing from 24 to 29%. And we're pleased with the right benefits that are coming through here. If you look at the bottom of this graph, you can see that the customer cost of acquisition is lower in the showrooms, and our customers are really enjoying it from an experiential point of view. So they're making payments, they can collect products there, and there's also customer service queries that can be resolved in store. So going forward, the targeted new customer acquisition coming out of retail will be around 60% going forward. So we're pleased with the right changes happening there. We're also pleased with the restructuring that's been implemented so that this business will be a niche retail player going forward, to generating double-digit returns and much more cash that will then support the group strategies so that we can be focused on the fintech growth going forward as well. Thank you, Sean.
Thank you, Paul. And I'll bring you back to the fintech vertical within the group. Looking specifically at the numbers in fintech, and I won't spend a lot more time on this graph. You can see the CAGR for revenue at 33% over the past 5 years, expenses coming down, only growing at 23%, and then resulting in PBT growth of 40%. So, really driven by the scale in this business, a growing proportion of fee income. It's now representing 37% of our income mix. We have a medium-term target to get that to 50% as we add more BNPL and insurance and B2B fee income revenue into the business. And really enjoying the scale that we get from our platform because of the investment in tech and data and the fact that our customer is so digital. We have about 1.3 million transacting customers on our base out of the 4 million customers. Looking at the customer specifically, very strong acquisition continues. We now last year booked 1.5 million customers into the ecosystem. That's a rate of a little over 120,000-130,000 per month. A lot of it coming from the viral adoption of the BNPL product. And what's happened is the weighted average cost of acquiring a customer into any of our products was only 57 Rand, and that's come down over time. And I see that continuing as more and more of our acquisition comes from within our ecosystem, bringing down the cost of acquisition. We now have 4 million customers in force. That's up 9 times in the past 5 years. Customers really like our platforms. We have a FinChoice branded platform and a PayJustNow branded platform, and really strong Google ratings from customers and high frequency. The average FinChoice customer is taking access to credit from her wallet or her loan about 7 times a year, and on buy now, pay later, transacting 5 times a year. And that's an increasing trend as more and more shoppers are seeing this as the smart way to pay at the till. Deep dive into lending itself. So lending grew nicely last year by 20% to 7.6 billion in disbursements. The vast majority of our lending transactions are done by the customer doing so on her smartphone. She can do it either on an app or our Mobi site. The Mobi site, the app itself is the fastest growing digital channel, which obviously makes sense as more and more of an evolution to using apps. And 95% of our transactions for new origination done digitally. And we reached a milestone with our wallet. This is the short-term 3-month credit wallet we offer customers. We had over 100,000 wallet withdrawals per month last year. A really sticky product that customers engage with from their smartphones. And important to note, we only have a 2.5% market share in unsecured credit in the South African context. We compete against all the major banks and other providers out there, and our share is low. We are growing and taking share, but clearly have a lot of runway still to take market share and grow the lending vertical. Onto the payments business, which comprises the BNPL product and also the Pay in 12 PayStretch product. On the top left is the cumulative disbursements at the till, the gross merchandise value. That's just over 13 billion has been transacted at merchants' tills in store and online, which has been in over 9 million transactions done at points of sale. We reached a milestone last year in the BNPL vertical in which the vertical itself became profitable. BNPL is a very low margin product, and despite this, the high volume of customers we have now has made the small margins pay dividends, and it's now covered our cost base, and we got into the black last year, which is one of the fastest BNPLs to achieve profitability actually globally. On the right-hand side, you could, at the top, PayStretch. We launched that at the back end of 2024 and really started to accelerate it into 2025 and tweak the product and enhance it and improve its customer engagement and workflow. And we've cumulatively done 320 million on that product, and I see this as being a nice growth vector for us going forward. On the bottom right, the Pay in 12 product is there for larger ticket items. The customer pays interest and fees for this product, but she's able to then afford something because it's spread over 12 months. We will introduce different tenures going forward, Pay in 6, Pay in 18, Pay in 24, for example, in order to best befit the affordability needs of customers at the point of sale. Every BNPL merchant has the option of allowing a Pay in 12 or PayStretch product at the till. So it's a great product because it fits on top of our existing BNPL ecosystem and integrations. Customers who use our products, bottom left, tend to get more familiar with them, and their frequency and their spend increases year and year and year, as this becomes the obvious smart way for customers to shop. Our insurance vertical had a nice growth rate in customers, up 32% in terms of premium sold last year in terms of growth, 220 million in gross written premium, and flat claims ratios at about 21%. And we continue to get more and more customers to buy insurance, which tends to be a grudge purchase and tends to be pushed by a broker or by an outbound call. We are getting customers to trust our ecosystem, trust our proposition, and buy her funeral product digitally. And that's now around about 50% of our transactions are end-to-end done by customers on their smartphone. Our personal accident products saw tremendous growth on itself, from a 6 times increase in the amount of policies we've sold. We've landed a new branding, so we've got PayJustNow branded funeral, PayJustNow branded personal accident, and we see that branding really helping in the cross-sell of PJN branded insurance products into the Buy Now Pay Later network. Looking at shopping and the merchant side of our ecosystem, the merchants continue to appreciate the trade and the new customers and the increase in basket size and improvement in funnel conversion that the BNPL product brings to bear. We're the #1 provider of BNPL in the country, and you can see in the top left graph the proportion of customers transacting in 2025, giving us over 7 billion in GMV. The vast majority, about 90%, came from customers we had previously booked in prior years. So we're bringing back repeat customers, we're driving up GMV for merchants, and it's being well appreciated. We've added a number of merchants last year. We have about 3,500 merchants across over 12,000 points of presence. So, for example, a ShopRite would be one merchant, but there are lots of ShopRite stores across the country. We signed up ShopRite and Takealot in Q4 last year, and are seeing really strong demand from those two brands as clearly a lot of South Africans shop at those two brands, and we've seen a lot of throughput there. What's really exciting on the right-hand side is the ability for customers to come to our app and search and discover new merchants, new brands, and new deals. We served up 158 million impressions of various merchant offerings per month to our customer base, which resulted in 48 million lead referrals back into merchants online and in-store locations at a click-through rate of 2.5%. So this has gone up 170% in terms of how we've monetized this. What's so exciting about this is we've got 4 million consumers who have buying power. They have a buy now, pay later or pay stretch product with a credit limit, who then come and they search on our site. They're highly intentful shoppers looking for deals. When they click through to a merchant, they're not just browsing, they're looking to shop, and they've got the buying power to transact and convert the sale at the till. So really compelling for our merchants to invest ad spend into this platform and see a very compelling return on ad spend ratio. I'm going to stop now for questions. I apologize. This was a slide that I sneakily put at the back end in the appendices, and which caught Paul off guard. Paul, do you want to just talk to this? This is about the fintech return on equity, which I think is notable and worth talking to.
Thank you, Sean. Yeah, I appreciate that. I was looking for that one. Yeah, so I think, yeah, this is the second and more exciting part of our active capital allocation relates to the, yeah, I think this gives much better color for the fintech business. So firstly, for those of you who followed our stock more actively, you'll be aware that we target collecting higher values than our outflows on our books. So if you look on the top left-hand graph, we collected 15.2 billion rand in the year, but we had outflows of 14.7 billion rand. How do we do that? So we actively are growing our fee income. I spoke to that being a higher margin item. It also drives higher cash. Secondly, the fintech products are all short-term in nature. So what that means is that we're able to turn the capital very quickly in this portfolio. And then thirdly, we actively manage our cash as a group. So we've got guardrails that we closely monitor within the group, and we manage within those. And our lenders know that. They've had that experience for some years now. So and a good example of that was that we were able to launch PayStretch, as Sean spoke about that. That utilized 200 million of cash during the year, and we were able to balance that within the portfolio of other cash items, as well as in terms of generating higher fees. If you look on the top right-hand side, then you can see the graph that the yield of that portfolio is now over 200%. In simple terms, that means that we've collected 15.2 billion rand of a closing book balance of 7.4 billion rand. So we actively manage the yield of this portfolio. If you look on that bottom, on that same graph, there's a gray segment there. You can see the increasing proportion of fees that's improving the collections coming off this portfolio. So that's a key strategy for us going forward, and also part of our longer-term capital management plans as well. What does that result in is, we're delighted with the improving shareholder returns coming out of the fintech business. So its return on equity is up over 600 basis points to 27% at the year end, 2025. And we're targeting for that to be over 30% in the medium term. So that's, I think it's quite clear on why we're allocating capital to this portfolio and the kind of returns that we're seeing improving from it. And that's then influencing the group's return on equity as well. So thank you, Sean. Yeah, I did want to land this point.
Thank you, Paul. Apologies for moving the slide to the appendices. We would like to take questions now, please. Can I ask the Unlock the Stock team whether we should go off presentation mode and go into, yeah, thank you.
I will jump in there. Thank you so much, Sean, Paul. Really cool. Good use of the color purple. I approve for obvious reasons. I also approve because I've been a shareholder for the past year after the last time you were on Unlock the Stock, and that's worked out pretty well. So thank you very much and congratulations and welcome to everyone on this edition of Unlock the Stock. I guess I'm going to kick us off with a question, just an observation, I suppose, from my side. If I look at your entire presentation and the way you conduct the business, it feels like a big part of it is about understanding your core customer and then building around that. And that sounds so obvious, but a lot of companies build around a product and then they look for additional customers for it, whereas you seem to go the other way around. And I guess I wanted to understand if that's a fair read on the way you run the business. I mean, if I look at your plans around mobile, around banking, it sounds like the glue here is we understand our client, here's what she needs, and you use the word she all the time because you understand your user base, as opposed to we want to own the product and then find people for it. Is that how this business is run day to day?
Yeah, I think you've nailed it. That's exactly right. The focus on the customer, and as I mentioned, the urban Black female in South Africa has been where the founder of the HomeChoice business back in '85 focused all of his marketing and efforts and merchandising. And we've just grown up over the last few decades talking about her, and she is the customer, and what does she want, and how do we serve her? Because she tended to have been overlooked. It's all about him and what he wants, and she intends to be the breadwinner, the stable one in the family, the one that we curate products for. And it's we take it for granted, but it's actually in our DNA to think like this. And it takes new staff who join the company a few months to get used to this awkward way of talking about she and her the whole time. But I really think it pays dividends. We design for her, and he comes along for the ride. And he actually quite likes the products as well.
Sean, or maybe a question for Paul. One in our DMs. I think it's a pertinent one. You know, what happens if somebody gets retrenched or they like pass away? You know, because I know the book is turning over quickly, whether it's BNPL or the short-term loans, but maybe just what happens there in those situations is kind of the question that the person is looking for, and like how do you kind of mitigate that risk, I guess.
Yeah, so all of our credit products come with credit life, which means that if any of our customers get retrenched, we service her installment obligations. If she passes away or becomes permanently disabled, the balance is written off as part of that policy. We also realize that our customers have life events that happen to them that we don't know about. Someone can get sick in the family, and you now need to spend money that you weren't planning on spending. So servicing a loan repayment, which she was doing honorably for ages, now suddenly becomes difficult. And we allow customers to go to our app and say that they're in trouble this month, and then they can make a part payment on their next installment. So it's a proactive way of working with us to say you're under financial strain, make a part payment in order to be able to service the installment that month. Some customers are also able to skip an entire month and then pay us the following month. So we try and work proactively rather than customer rolling and having a bureau record black mark because of missing an installment. Work with us to do it. And she does this digitally herself, which is quite empowering for our customers. She doesn't have to phone us and beg and plead. It's a proactive utility we've developed. It was used extensively during COVID, where customers had financial strain, as you would all expect, and it was very empowering for our customers to keep themselves up to date by paying less, but meeting us halfway with a part payment.
Yeah, perfect.
If I just look at that ecosystem that you guys are building, it's this kind of two-sided marketplace, I guess. It's got customers on the one side, it's got merchants on the other. In terms of those two profit pools, they are quite different, actually. And if I look internationally, if I look at companies like Amazon, for example, and Walmart, and even locally, I think retailers are starting to behave this way, where they see it as a great opportunity to actually help FMCG players reach customers and to actually tap into their distribution and to see it as an asset. It feels like that thinking is coming through in your business as well. And I guess I just wanted a bit more commentary on that, I suppose, in terms of that profit pool of actually working with the FMCG players on that side of things. And then linked to that, because I mean, you make the point quite correctly, someone who's on the app has intent to spend. You know, that's not an app you flip through for any other reason. So that's obviously very valuable. And it's kind of this like deals culture, right? So I imagine stuff like Black Friday is very important to you and that kind of thing. And you become a very useful distribution channel around events like that, right? I mean, is that sort of thinking about it the right way?
Yeah, I mean, absolutely. It's nice having a big platform of captive consumers linked into a platform of merchants, because when there are Black Friday deals, it's an obvious place to go and look. We obviously prep our customers going, look, Black Friday is coming, make sure you've got your facilities in order and look at what you want to shop, because the deals will all arrive. And we work with merchants to proffer deals on our site. So it is quite a nice virtuous relationship between the customers and the merchants and ourselves with respect to that. And in terms of, you said two profit pools. There's the consumer side and there's the merchant side. And merchants have products that they service on their own, such as insurance products or a personal loan product, and but they also have payment products which obviously link in with the merchants. And on the merchant side, the benefit to merchants is that they are having access to customers and access to customers with shopping power, and then access to being able to advertise to those shoppers to bring them into their stores, and they're highly intentful. So the bang for your buck on your ad spend is very strong. And because of our data, we can really show, to those advertisers exactly what they're getting for what they are spending. It's not above the line, it's direct marketing, if you like. We know which consumers have seen your advert, which have clicked on it, and then which have checked out with one of our products. And that whole continuum can come back and report to those merchants to show their return on ad spend and the GMV we're driving for them.
Sean, I wanted to touch on the retail business for a second. I know Chris DeWitt isn't with us today. He was here with us the last time you guys were on, but just on improving that side of the business, I know it's going to be a focus now, but can you give us a breakdown within the business? How much is credit sales versus cash sales, and how kind of future store rollouts and just kind of some of the strategies that we're going to see play out over the next 12, 24 months to try and improve the operating performance of the retail business, because I think you've got 60 odd stores now, so it's not a small operation to try and turn around, and can have an impact if you can get the margins kind of more in line with kind of industry norms.
Maybe Sean, I can take this one if that's okay.
Or Paul, yeah. Paul.
So Mark, the cash sales proportion in 2025 in the retail business was 9%. And going forward, we'll look to lift that, over 10%. One of the key drivers of that is the showroom strategy. So our experience is that customers are actually, we've got 20% of sales in the showrooms are actually cash sales. Okay, so you'll just see a natural mix lift for retail, but that's a key driver for us. So that retail business needs to be generating more cash. You're managing the risk as well with that, and then obviously lifting your returns going forward as well. From a growth point of view, so we've ended the year with 60 showrooms. We're going to slow down the growth on those showrooms going forward as we look to optimize the returns coming out of that business. So what the plans are to grow up to another 5 showrooms in 2026. You know, we will keep exploring what that kind of growth looks like going forward. But what's key for us is, from a strategy point of view, it's around quality of earnings, and it's also around the returns from that business. So that's what's important for us going forward. So it's less around the top line growth and just making sure that the credit quality as well is improving, and then driving improved group shareholder returns as well.
Yeah, I mean, I think that the focus on showrooms, it brings in more a higher cash portion customer. It brings in a better quality of customer, and with us not doing outbound telemarketing to lists anymore, that this has become the core strategy for acquiring and engaging customers, as well as obviously digital as well. But the good, as Paul's saying, the business is slowing down its growth. It's focusing on the quality of earnings, the quality of its bad debt, and hence getting into double-digit profit margins and return on capital.
I've received a couple of questions in my DMs. It's 3 questions from one potential investor. So if it's okay, I'm gonna lump 2 of them together a little bit, and then I might just ask for if I can just have the follow-on. So the first one is just your competitive advantage against other unsecured lenders, like a Capitec, for example. Like, why do you believe that you're doing well in this space, etc.? And then just kind of linked to the actual, you know, I suppose the transaction each time, like the choice of stretched payments versus paying off sooner, etc., and how that decision kind of rests with the client, the merchant, etc. I think just maybe getting clear on exactly where that decision rests, and then you have guardrails in place, right, around maximum terms available to each client. So there's a choice, but it's within a set of rules. So that's the one question. And then just how do you compete against the other unsecured lenders? I think let's do those.
Yeah, so let me just start with the first one about how we compete against other unsecured lenders, especially in a class outfits like Capitec. When I started the FinChoice business about 20 years ago, Capitec was a new bank on the block, aggregating lots of micro lenders in order to, you know, compete in the unsecured space. And I remember thinking to myself, how are we going to compete against a bank where their cost of capital is cheaper than ours and their distribution is across the country and so on. And I quickly learned that, you know, we have a fantastic direct marketing knowledge in this business, born from back then 20 years of retail heritage, where customers had learned to trust the HomeChoice brand, selling at a distance with products they hadn't even seen or touched or felt. And that trust equity and our ability to then take proven customers and target them with credit that they were pre-approved for, because we knew who they were and what they could afford because of their time with the HomeChoice business, really, you know, gave us traction. We had a list of customers that no one else had. We had trust equity with them, and we knew how to talk to them. And that whole ethos has permeated the growth in this business across our migration from tele into being a purely digital business now. And that's how we compete. And if you look at our growth rates in the business, we have steadily taken market share and tend to grow our disbursement outgoings at a greater rate of growth than other competitors. I hope that answers the question. And on with respect to the payments products, so what's the experience at the till? So a PayJustNow merchant has enabled buy now, pay later through an integration into our systems. We integrate, all the smaller merchants use WooCommerce or Shopify or those kinds of platforms for which we have APIs integrated. And they then enable the BNPL brand to be a checkout method. Consumers would go to the checkout and see PayJustNow. Upon clicking on it, they can choose to pay in 3, or if they've been pre-qualified, to pay in 12. And then she makes a decision in real time as to what she wants to do. And in time, there will be a range of tenures that she could elect. So it's fairly seamless at checkout as to her decision point. It's there The merchant can decide to offer both or just the one. But typically the merchants are offering the full suite that we offer, and customers elect in real time how to transact. Did I get those questions all answered there, Ghost?
Yeah, I think so. Maybe then I can just do the quick follow on and then I'll let Mark back in here. So it's just around the accounting for your collections. I'm assuming when you collect, you're recognizing capital's coming back and then you're earning income on top of that. Essentially, I guess just confirming that it's not, we put out money, we collected some of it and all of it comes back into income. I guess just checking in on the accounting of how those loans are accounted for as they're repaid.
Yeah, I can confirm that. We'll recognize the fees and interest, etc., as revenue, and the rest will be a reduction in the book. So yeah, the normal process.
Okay, since we're stealing 2 questions at a time, I'm going to get 2 questions in here quickly. Ahead of the Ghost. These are probably quick ones. Plans on rolling out to neighboring countries. Obviously, you're bringing on merchants here who operate, let's say, in the broader SADC region, Bots, Namibia, Zim. So, maybe that is the first one, and then I'll tackle the second one then after that.
So we don't have immediate plans to take our model into adjacent countries or into other African countries. We know that's an opportunity. We just have such low market share in our current verticals and so much growth potential in front of us that we want to continue to grow our platform that way. We will, when there's an opportunity and look at going to either an adjacent country or one of the larger African countries, but it's not in our immediate future, but it remains an upside for us.
And another one, this is linked, I think, to liquidity in the stock, which is even by small cap standards under JSE on the lower side. So there's a question about considering a rights issue for existing shareholders, but maybe let's not touch on the rights issue per se, but just liquidity in the stock, because it is quite a tightly held share. Maybe just a comment on that, and any plans to, whether it's underwritten DRPs or some other mechanism to try and improve liquidity.
Yeah, look, we are aware that our free float is relatively small, and hence it impacts liquidity in the share. The shareholders know this, and we are in discussions on what we can do there. But I can't comment further than that. It's definitely something we want to, excuse the pun, unlock the stock. But I can't share with you what we're thinking at the moment. There's a lot on the table for us to debate.
I quite enjoyed that.
I can just add to that. Sorry, I think it's been great to have the rebrand to Weaver Fintech. So that alone, I think, has also created some movement in the right direction. So yeah, but this remains a board conversation.
Yeah, absolutely. Look, if you want to put another 10x on the multiple, just call it Weaver AI, and then that'll work for at least 3 months. Jokes aside, though, maybe a question from my side just around all the observations I see in the market. And again, I care way more about the strategy on most of the things I invest in than the specific numbers in any given year. I look at all of that's going on in omni-channel, and it just feels like everything is about digital adoption everywhere that I look. Like every single retailer that I'm reading about in South Africa is talking about that. And South Africa is still way behind markets like the UK, Australia on online sales penetration. So I would imagine that with the business you've got now, I think if you were just HomeChoice, I guess you'd have to be quite worried about how everyone else is becoming so much better at omni-channel. But because you've got the fintech side, you now sit further up in the value chain and you participate essentially in all of that, right? Is that a good way to kind of bring together a big part of the investment thesis here?
Yeah, I mean, in other words, we are helping facilitate a lot of omni-channel engagements for the broad retail market out there.
Yeah, and getting the payments piece on it, right? I mean, it's the shovel. I kind of see it as like the shovels in the gold rush around online adoption and omni-channel. Yes,
we're providing that glue that facilitates the transaction where the money is, right? And as well, and on top of that, giving merchants access to consumers that wouldn't ordinarily shop with them or even know about them. we want to radically increase our merchants this year by 4 or 5 times, by a big drive to get out there, add a few more of the big tier 1 merchants where our customers obviously shop, and as well as mid-tier and smaller merchants to give them exposure and to broaden the search and discovery that our customers are looking for. It's quite hard to find certain merchants because customers don't even know they're there, but we're going to start curating personalized offers to our customers based on their behavior and hoping to give them some surprise and delight in terms of finding different merchants and offerings on our platform.
Maybe I can add to that, Sean. It's just, I think you can't underplay the value, the experience that we have as a group in terms of UX and engagement. And yeah, I think so. Just to add to that, I think this track record that we've got, yeah, it's all very well to sell online, but I think if your online experience or your UX isn't good, consumers vote with their feet. And what you're seeing from a rating point of view, I mean, both FinChoice and PayJustNow, their Google ratings are well above other players as well. So yeah, our consumers are really enjoying their engagement with us.
One final one for me, I think we'll have to wrap it up then. The question is around how dynamic is the interest rate on the Stretch Pay product? And if I can just add on to the end of that investor's question, yeah, I guess maybe a little conversation about how you monitor credit quality, monitor the performance of the book, and how you can adjust criteria or interest rates up and down to try and insulate yourself from bad debts are creeping up, repayments is kind of creeping up across, when you look across the whole book. So maybe just how you manage that risk dynamically.
Yes, just in terms of how we manage risk, our book is pretty short term. The BNPL book's 43 days long. Our average term in our lending book is 13 months in terms of what money we disperse out there. Our Mobi Money product, which 70% of our lending customers use, is a 3-month product. So we learn very quickly when there's distress, and we can tighten our thresholds and our policy. In terms of the interest rate on the PayStretch product, so we're developing a few different PayStretch products. So we can have one at facility interest rates and another one at installment rates. So we could then price for risk, so to speak, in our market segment. And that's something we're going to launch in the next 2 months, so we can offer a range of different interest rates based on the type of risk quality and the pricing appetite of customers. And that'll be quite exciting in terms of being able to be a bit more dynamic in terms of pricing risk and pricing for appeal to our customers.
Okay, perfect.
So thank you everyone who chose to spend some time with us today, and a special thank you to Sean and to Paul, who made time for the retail investor and to engage in this platform. Thank you both very much for that. Our next session is on Thursday, the 19th of March, which is next week, and that is with Growth Point Properties. So please look out for that invitation. And that is then all from my side. Thank you very much. Goodbye.